Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of LME 3-month copper, aluminium and lead. LME 3-month copper. Once again, I feel obliged to state, as I have now for many months here, that there are 3 important congestion zones, which in turn have become either important support zones or resistance areas, and continue to impact on the market. Above the current market is the highest and possibly the toughest of these congestion zones, between 97.50 to 99.95 area, although recently prices managed to stray above it, only to each time get slapped down. Today we are edging sort of around, up and out, and not so much, the middle zone in the 93.95 to 96.06 area, which at the moment contains the slowly declining mauve medium moving average, currently 94.61, and a short medium moving average, currently 94.70. Finally below is a smaller one between 91.83 to 92.56. This last one saw the market push up through it 10 weeks ago, then get capped by the next congestion zone, that 93.95 to 96.06 zone, plus at the time the declining short medium moving average, and we ended up back down below it again, before 6 weeks ago tackling it once more, and 5 weeks ago pushing up through it. Prices then traversed the free area up to the 97.50, 99.95 area, where we tried pushing even higher for nearly 2 weeks. However, 3 weeks ago prices started their journey back down, pushing below and out of the 97.50 to 99.95 congestion area and into the current 93.95 to 96.06 congestion zone. The last 2 and a bit weeks prices have been pushing down onto the mauve slowly declining medium moving average. Now, if it wasn't for this moving average, then prices may have been a lot lower. The mauve medium moving average is now being reinforced by the green rising short medium moving average, though I don't know how good a reinforcement that may be. So for now it seems we will continue to rely on the 3 congestion bands. LME 3-month aluminium. There continues to be a lot going on here on this daily chart. The move higher over March, April, May, and I suppose even the most recent one from early August originates back to late February, with the market breaking higher from a diamond pattern type formed back then, between late October 2023 to late February 2024. Now, please remember this, as it is the congestion generated by this diamond pattern on the wide between 2100 to 2400, but really between 2156 to 2297, that caused the very recent rise since late July, though obviously not the original pattern itself. Okay, so the decline from late May to late July was stopped by the extension to the neckline, currently at 2215, to June to July reverse head and shoulders neckline pattern. From this base, prices started building and experimenting upwards from the same price zone as the earlier diamond bottom pattern, roughly between 2400 and 2100 zone. In the process, prices pushed up through some significant resistances, now turned supports. The nearby notable ones were and are the congestion zone from mid-June to mid-July, between roughly 2485 to 2563. Containing the key levels at 2485, 2508 and 2563, plus the bright red middle time currently at 2562 of the mid-December 2023 to late July this year shallow rising bullish shift pitch hook. Next we have a shallow bullish shift pitch hook with a late July to early September move that I drew 5 weeks ago and said at the time, and I quote, "This last one I'm happy to finesse or even retire as the market demands," end of quote. Well, the market originally demanded I finesse this to a more acute bullish Andrews pitch hook, but after a while that stopped working, and so I've reverted back to the bullish shift pitch hook despite it being breached on the top side back in early October. It is highlighted in dark blue on my daily chart. The final pattern to consider is a new one, and that's the bright green October based bull channel, currently 2590 to 2733. It is just developing and it sits right now roughly in between a dark blue middle tine on the downside, currently at 2606, and a dark blue upper tine above, currently 2739. So after all this recent back and forth, it seems the market is trying higher, utilising the bright red and dark blue middle tines, as well as a new bright green lower bull channel line as a base of sorts. Whilst overhead we have congestion, primarily from the big old 50% Fibonacci line of the 2008 to 2022 move at 2675, but assisted by the August 2011 high at 2666 and the 2023 high at 2671. Last week I said about this overhead congestion, I quote, "It'll be interesting to see if this cap is as strong now as it was back in early October," end of quote. So far it has been, but it is being sorely tested right now. And please bear in mind that the lower bull channel line and the dark blue middle tine, well, they cross over through that 2600, 2680 area at the middle of November, so time is limited in how long it can keep doing this. LME 3-month lead. There are a number of significant features on this daily chart. The first I'd like to mention is the immediate overhead wide band of congestion originating from April between roughly 2135 to 2186. Congestion area that showed itself at the peak 9 weeks ago and again over the start of October. Next I'd like to detail some of the supports below, some of them well below Fibonacci based congestion otherwise, between 1994 to 2002, followed by the June 2023 low at 1976, which looked, how shall I put this, which looked less interesting, and then the 2024 low in August at 1917, which I suspect is a function of the nearby 2021 low at 1908. There's also a neckline extension, currently at 1941, of the July 2023 to February 24 head and shoulders continuation pattern. The reason that I mention these supports below is that they contributed in eroding the decline we saw in early to mid-September, enough that it was stopped and turned back upwards and brought about eventually a new pattern, a bright red, early August to early September bullish shift pitchfork. The market since the middle of October had been tramping around the middle time, currently at 2085, but late last week prices broke down, specifically down through the green highlighted flatlining short medium moving average, currently at 2063, and congestion at 2058. Indeed, the action over most of October could now be seen as a hesitation. I added to this comment last week on this, I added this on the comment last week on this matter, and I quote, "Question now is whether the hesitation is part of a bear flag type action or a new base for a possible attempt higher. It just seems that both topside and below we have some considerable resistances and supports, which I detailed earlier. I suppose that is why the market is seemingly marking time right now," end of quote. Well, it now seems the hesitation has become a bearish halfway hesitation, with a potential move down to target X in the 1980 zone. This would be a direct test of the integrity of the bright red bullish shift pitchfork, as the lower time is right in the way, currently below at 1989 and not too far away from where the market's dropped down today. But that is not all, as if we do get down there and continue, then please be on the watch out for 2 bearish and 1 bullish possibilities. The action from August to date could then be seen as a possible large bearish cat's ears pattern, or even a larger July to date bearish halfway hesitation. Alternatively, could then be an opportunity for a mid-July to date triple bottom. Not yet is the answer. I don't know which one it's going to be, but this is all getting very interesting now. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Service International Limited. And here comes the final important bit.